I'll embarrass Brooke a bit here. We've done about 23 of these conferences together. She does a great job.
One of our guys was there.
Hopefully, we've another 23 units. Brooke? We'll have a go.
At the meet.
Ladies and gentlemen.
Are we going on the road, mate?
I'm on, but
up.
that's just a fireside chat. This is
Strange.
all right. I think once they hear my tones, they do come in occasionally. But it's good that we now got this second session, which I'm very excited about, having 5 strong platforms with brands in various stages of being developed. And with Select Harvest, the scale is coming through, which is fantastic as well. And what we'd like to do is start that off with Bega, with Gunther Burghardt, the CFO of Bega, presenting. And he'll sit in the audience while Gunther talks for 10-15 minutes, then ask some questions, and then to go to the next 4 speakers and have a panel. And if the Q&A is the same as what it was in the morning, room for a fantastic time.
Great, thank you very much, Paul. And yes, it's the graveyard shift after lunch. I'm fully cognizant of that. Now, first of all, I just want to see, does this actually have my presentation? Oh, there we go, very good. Yeah, it's a special time for us at Bega. Last year in 2024, we had our 125th anniversary that we celebrated. And 125 years. So some of the question as you deal with the themes of this conference and being sustainable is how do we thrive and grow for another 125 years? Now, don't tell our chairman, Barry Irvin, this, but as a newcomer, I've been there a little under 3 years. My perception is in the first 100 years, not much happened. From 1999 to sort of the late 90s. And in the late 90s, Bega was a very small company. Had 1 or 2 cheese sites in the Bega Valley, which is the sort of spiritual heartland. And they were doing maybe 30 million in revenue. Now, the journey in that last 25 years to go from 30 million of revenue to 3.5 billion, a lot more happened. And I want to talk a little bit about that. But more importantly, I'm going to touch on 2 themes. We did go, in spite of that breakneck growth, I think after 2020, there was a few different factors that really impacted the company. They did a branded acquisition, their second largest one. So the first largest one, Michael Spiteri here in the audience, came to us during the Vegemite and peanut butter acquisition in 2017. And that was the first really big bet on brands. And before that, the company had been predominantly an agricultural company. We will always be rooted in agriculture. But the question is, how can brands lead our agricultural story? And that interface with consumers, it reduces volatility in our earnings, right? And those brands, if they can be in the hearts and minds and pantries of consumers across Australia, we believe that is the key to our success. So we did the Mondelez acquisition in 2017, and then in 2021, Lion Dairy and Drinks acquisition. So we got some fantastic brands like Farmers Union and Yoplait and Dairy Farmers and Super Duper for you who have young kids there, and they're one of the thirst quenching during hot summer days. So dozens of great brands came to us through that acquisition. But a very interesting time, the middle of COVID, big impacts to the company, hurt the earnings, real impact. Right? As soon as that was done, a $300 million increase in milk prices and sort of an explosion in inflation. So that began to roll through in 2022. And just when we thought there's no more shoes to drop, 2 of them have already dropped, then the commodity markets globally for dairy products plunged in the following year. So a lot of shoes dropping in 2 or 3 years. And I think that really strengthened our resolve to become a brand-led company. And so what I'm going to talk to you about today in about 15 minutes is the 5-year strategic plan that we sort of set in 2023. And it is about our transition from a commodity-led company to a brand-led company. Our bulk ingredients and nutritional business will play a role for us, and it's an important role for us. And last year in F24, our bulk business lost about $18 million. And I had a lot of investors, a lot of analysts coming to me going, why don't you sell this thing, Gunther? Do you really need this business? Believe me, we got deep into our analysis of this thing. Truth is, if you're buying 1.3 billion liters of milk like we do, you need to be good at it, and you need to be good at processing it. It's about security, it's about value, it's about sustainability, it's about interface with the farmers, right? But it adds more value beyond that. Our bulk business, interestingly, creates things like cream cheese. Bega cream cheese on a retail sense is not huge here in Australia, but we export almost 30,000 tons of cream cheese overseas into Asia, into the Middle East, into Japan, right? The bulk business enables us to process the milk and to do things like that. High value ingredients. I've heard a theme this morning from the 4 companies that presented to us. How do you increase the value of some of your agricultural bulk products? So we do a lot of skim milk powder, but that's kind of the base ingredient in dairy processing. Our success will be about things like lactoferrin, milk protein concentrate, those higher value proteins that we can create. For our bulk business, that's where it can add value beyond just being a great supporter to the branded business. We're in the second year of this 5-year strategy in F25, and we've just released our first half results a couple of weeks ago. As part of the strategy that we described, we gave an update to the market. Every time we talk to them, we go back to that strategic plan. How are we doing? Are we meeting the milestones? And one of the things we report on is this third point, channel and market opportunities. As you'll see later on, the major grocers in this country are important customers for many of you. I heard them called out this morning as being very important. And like many of you, we have to find the right programs to delight them and consumers that walk into their stores. And I think that Lion Dairy and Drinks, the Mondelez brands like Vegemite, they have a great history of being successful in grocery. But if we're being critical of ourselves, what Bega hadn't done well is to be as successful in the other channels. We often had first or second market positions within grocery, but in areas like food service, we're number 5. And so part of our strategy is how do we lift up those other channels and do the patient, sustainable kind of investing that we need to do so we become more balanced in terms of channel and market opportunities. The final thing is just remembering to keep a firm eye on our shareholders and investors and that disciplined cash flow focus. We've really spent a lot of time on that the last 2 or 3 years. What is the right capital allocation? Where do we invest our CapEx? What does our supply footprint need to look like? These are all objectives and key goals of our strategic plan. So first of all, a little bit about our vision and purpose. And it's funny for me to sit in the midst of a bunch of really great food and agricultural companies, but our vision is to become the great Australian food company. And I think if we can take that sort of momentum from $30 million 25 years ago to $3.5 billion, the question is, where can that lead us and how long will it take to get there? But we love the momentum. And I think if you shoot for the stars, you'll reach the sky. And so it's a big vision, but it's one that's very much sort of inculcated within the company. The purpose, creating great food for a better future. I've heard so much about that this morning, whether it's been animal food or food for humans. How do you make high quality products that engender the trust of your customers and your consumers? So that's our vision and purpose. But within that, how are we going to get there? And this slide here probably does the best to summarize that. On the right side, there's sort of 6 strategic pillars that we have that's going to enable us to achieve that vision and purpose. The first is protecting and growing the core. And when you think about strategy, it's about choices. And I heard a comment earlier, you have to choose what you are going to focus on, but you've also got to choose what you're going to do less of. In our portfolio, not all categories are created equal. So things like milk-based beverages, our fabulous Dare brand, or Big M, or Masters for our friends from Western Australia, or Farmers Union Iced Coffee for our friends from South Australia. Those are regional heroes, and Dare is a national hero. But that milk-based beverages category is really important for us. So when we say protect and grow the core, we're thinking about 3 categories: milk-based beverages, yogurt, and spreads. And for us, those 3 categories are more important than the other categories. Fresh white milk is huge for us. It's the largest revenue category we have, but its margins are razor thin. It is a very competitive category. So when we allocate marketing people, launch resources, innovation, sales focus, we do it behind these 3 categories that matter. That's protect and grow the core. Win on the street, that's about growing those channels, continue to support grocery and the discounters, but this is about growing those other channels, local trade, food service, institutions. We won the New South Wales health contract last year for milk and a number of other products. Hard to get in there. Again, you need patient investment and focus. But when you do, these are large sort of governmental institutions. And if we can partner with them to bring their clients, their customers, great quality food products, that helps us be even more sustainable as well. Streamline our sites. It was interesting at the AgFood kickoff this morning. People listed some of the issues that they have as businesses, and right near the top of most people's lists was labor. It is a very tricky labor environment. On one hand, it's an opportunity. If you can get the best labor, you can get the best skill sets, it is a competitive advantage. I would say that some of the regulations recently in the environment in which we operate for labor is very difficult. So for us, the question is, we have to sort of bifurcate our production sites. We have some super sites. Wetherill Park in Sydney is full to the gills with sort of milk-based beverages. We've had a terrific yogurt site here in Morwell in Victoria. Again, it's just ordering its third pouch line for yogurt pouches. So those super sites are seeing a lot of the investment, but there are some sites that are not going to see the investment. Again, strategy is about choices. We shut down our small site in Canberra. We moved the volume into the Penrith site. We shut down 2 sites in Tasmania and consolidated in the Lena Valley. It's not about shutting sites down. It's about when you have fewer sites, you can invest properly behind the ones that remain, and you can build the capabilities, you can build the efficiencies, and you can build the scale. So the third thing is about that streamlining and that focus within our supply network. It's not just factories. I heard the presentation yesterday evening from IFDA on cold chain logistics. We do probably 30 to 40,000 deliveries a week with one of the largest cold chain networks in the dairy industry. It's a great competitive advantage for us, but if I'm to be honest, we probably haven't used it as much as we should have. So what we're doing now is figuring out how do we get more products on there that have higher value for our customers? How do we incentivize them to do that? And on the left side, we launched a few months ago a new portal for our customers. We have nearly 30,000 customers in that local trade and that food service channels who order through that portal. They were using a 20-year-old green screen that you had to type the product number in. If we were getting sales with that, putting in proper technology, becoming more frictionless to do business with, we're already seeing some great gains in that area. So it's about how do you delight your customers? How do you delight your consumers? Sustainability, I'll talk a bit more about that later on. And what we're looking for is things that can achieve our sustainability objectives, but also make financial sense for the company. I'll give a few examples later. Securing solids, it is a limited milk pool in this country, so we've begun to secure solids overseas, and that's been important. And finally, the international opportunity. We have $250 million in sales, which is a fairly small single-digit percentage of our business currently. But when you think about it, there's 4.5 billion consumers in Asia and the Middle East where we sell our product. They have cities bigger than the population of Australia. So we're very excited about that. And for us, that is an area where we are allocating more resources, is to grow in that area. This is our strategic plan and what we look like in terms of results by F28. So F24, as I said, that was the first year of our strategic plan. And F23 was a really challenging year. And in F23, we had less than 4% ROFE. And I started that bottom row because for us, return on invested capital, or some of you will call it ROFE, very similar measures, that is the measure for us that matters more than anything. But to drive that, it's not about share gains. It's not about a fight for revenue's sake. For us, the most important thing we can do is to grow our gross margins and our EBITDA margins. You can fight for revenue all over the place, but you can start some price wars. What's important is how you do effective promotions, where you can take pricing, and how you bring value-added innovation that is going to drive your margin forward. This year, we've had to rely more on cost savings because that pricing lever has become more difficult in this consumer environment. But make no mistake, if we don't grow a margin, at least 100 basis points a year in margin, that's what we need to do to deliver this plan. And we have in sight the levers to pull that will get us there. If we do that by F28, we will triple our earnings per share from less than 10 cents last year to almost 30 cents. That's the vision that we're painting. That's the outcomes if we can execute the strategic plan. The good thing is, in our first half, I'll flip forward to it, we're off to a good start. So in the top right, we've seen our normalized EPS at 12 cents go up 170%. And within that, I'd say a couple of things. We had a recovery in our bulk and our ingredients business, and it lost money, as I said, last year. So it was really pleasing to see that business robustly return to profitability. In the long term, we expect that business to earn 30 or 40 million a year. That's not a great return on assets in itself. The replacement value of those assets is probably $1 billion. But remember, its mission is to support our branded business. That's why that bulk business is there. So that's an acceptable level of returns. What's more important for us is that huge branded business. It surged to $200 million last year, but this year the growth is slower. Getting price, as I said, through the customers and the consumers is difficult. We have less than 1% pricing. So how we deliver those cost savings in manufacturing, in logistics, in procurement, that's what powers our margin. And then sort of value-added innovation, that's the cream on the cake. And that's what we need to bring to sort of balance margin and revenue growth. So this year, we may only grow 5, 6, 7% in our branded business. But actually, if we can do that each of the next 3 or 4 years, the F28, that's all we need to do to achieve our strategic plan. So it's not a crazy set of assumptions. So I'll finish off on my last slide here. And I do want to show these innovation on the way through. And these are the things that make a difference. So on the top left, Dare Protein is probably one of our big ones this year. Dare is an energy drink. It competes with Red Bull. It competes with V. It competes with drinks like that. Launching functional benefits like protein, you not only provide energy, but you provide functional health benefits to consumers. So that's been terrific. So our big slate of innovation. And what we're leaving people with is that we are very confident in the material step up in our earnings this year. We'll go from 164 million this year to the upper end of 190 to 200 million. So it's a big increase in EBITDA for our company. And our first half gives us a tremendous amount of confidence that we'll be at the upper end of that range. More importantly, we have the bricks that we need over the next 3 or 4 years to deliver our strategic plan. That's it. Thank you very much.
Super, Gunther, I reckon. Now, any questions from the audience? We've got Joe in the back there. I can always chip away. So I'm interested because culturally it's been difficult, I think, for Bega to do this consolidation. So can you sort of talk through that and give us comfort that it's a sustainable sort of move? Because removing people has not been what Bega's done up until 3 years ago.
Yeah, that's a fair point. And I think, there's obviously another acquisition being discussed out there in the industry, within the dairy industry. And some investors will ask us, if you look at the acquisition of Lion Dairy and Drinks in 2021, how would you evaluate yourselves in terms of how you've done? And I would say the answer is we're very pleased at where we are now. The truth is it took us a little time to develop the muscles of a branded company. And when you transition from an agriculture or commodity-led company to a branded one, those marketing muscles, those selling muscles, execution in store, the right promotion, it takes time to build that. And in the last sort of 4 or 5 years, the company has spent a lot of time building that muscle. COVID and a few other things and that hesitancy about becoming a branded business probably delayed the synergies a bit from the dairy and drinks acquisition. What we are absolutely certain of now is we have those muscles, and future acquisitions, the thing will be how fast can you deliver the synergies. What we're demonstrating every year with our strong cost savings program is that we're doing it every year. Our results this year were powered by cost savings, and you know what, they probably will be next year too, because the consumer environment won't get easier. So we're demonstrating year on year in the last 2 or 3 years that we can save money well, and we can apply that to synergies in inorganic situations also.
You should say where you're from, Rob. Because
Rob Nelson from Real Dairy. So Of all the industries in the room, I think I'd be right in saying that dairy is the only one where the manufacturer has to give a guaranteed minimum price to its suppliers, milk suppliers. How big a and that's mandated through Canberra. How big a hamstring is that for the industry as a whole and for Bega especially?
Yeah, it's an interesting point, and the dairy regulations, as you said, on June 1st of every year by 2 p.m. we're required by regulation to post for every state and every region and every state in the country our minimum price for the next 12 months. When we do that, it can go up from there. It can never go down. And so I want to be completely transparent. In that bulk business that buys the milk, because they're the ones who do that procurement, it does introduce an element of volatility, right? And as soon as you've got a situation where global commodities move up and down, but your milk price has a minimum floor, that volatility is there. Our response to that is the bigger and bigger our branded business can become, the less that volatility matters. So right now, this year, our branded business will be over 85% of our earnings. That doesn't mean we don't have volatility from that. We do. But if that volatility is constrained to 15, 10% of our total earnings, it becomes smaller and smaller. So the answer is it has an impact. And the response is, how do you minimize that volatility? You do it by having strong brands, is the answer that we've found to that.
And Andrew's in the middle. Another dairy owner, perhaps.
Scott Wilson come off that. That was great. Question around private label versus branded in the supermarkets. We talk about branded product and 1%. You talk to us a bit about the mix or split between private label and branded, and obviously they come at different margins. That's part of the baggage with the strings attached to having a certain amount of shelf space from branded.
Yeah, it's a very good point. And I want to be very open with people. Of our 3.5 billion of revenue, $500 million is, or 600 million is the bulk business. What we call branded at 3 billion, about 750 million of that, at least maybe 800 million, is sort of third-party manufacturing, contract manufacturing for retailers. So different companies in the sort of FMCG game have different responses. Some of them go, I'm never going to do that. But in a huge scale game like food, our position has been, just as you mentioned, if you can be their one-stop shop, if these big customers call you and pick up the phone when they want you to do some private label as well, as long as there's some kind of separation between the brand and the private label, you build a unit scale advantage that's important. And you also build a relationship with them that's important. So we've gone the other way and we have embraced that. It is a low margin business. Our core branded business actually makes a lot more money in margins than our total branded unit would show, but that several $100 million of contract manufactured stuff is in there. What's exciting for us is some of the new discounters. So we want to delight Coles, we want to delight Woolworths. Some of the biggest growth we're seeing is people like Aldi. Aldi's growing in the double digits. None of this is measured by the market shares. And so we've been dealing with Aldi for a very long time. They're one of the top 5 sellers of Vegemite in the country. So they do some brands, but they do a lot of private label. So how do you delight them? How do we have the right products that can deliver for their consumers? And then how do you also get a basket of your brands sold in at the same time? That's the delicate dance at which we need to succeed.
That's right. I thought we might ask more questions about consolidation in a broader setting, so you can sort of be a bit more circumspect about comments. But thank you very much.
Thank you.
Sam's jumped in real quick. I like this. So very happy to have Sam Beaton here. We've had Cobram here since CBA was associated with us 4 years ago, and we haven't had Sam speak before. So this will be fantastic to hear what actually really goes on at the commercial edge. Leandro's been telling us about the growing side.
Yeah, thank you. And thanks to everyone for joining us and sponsors for this event and those joining us online. And great talk about Bega. I'm here to talk about Cobram Estate. We're relatively new to the public space. The business has actually been around for 25 years, but we listed on the Australian stock market about 3.5 years ago. My name's Sam Beaton. I've been with the business for 15.5 years. I started as the CFO and then I've been joint CEO with Leandro for the last 4 years. So Cobram Estate, just a recap on who we are. We're one of the world's largest vertically integrated olive oil businesses. We're in Australia and in the USA. In Australia, we have full vertical integration from the tree nursery through to the olive groves, where we have just over 7,000 hectares of planted olive groves. We have 2 large-scale processing mills at our olive groves. We have storage down at our facility just out of Geelong. We also have a bottling line and a laboratory. And importantly, we own the brand. So the vast majority of our oil or extra virgin olive oil gets sold through packaged goods channels. So Cobram Estate, Red Island, and private label. In the USA, so we moved to the USA around 10 years ago, and really the aim was to replicate what we'd done here in Australia, and we saw some pretty interesting fundamentals there that certainly help with our business case. We're now becoming a decent size, and it's becoming a big part of our business. We have around 1,000 hectares now of our own groves in the USA. We contract with about 2,000 hectares of third-party growers. We have our own processing mill, storage facility, bottling line, laboratory. Sounds familiar. And we also launched our brand about 6 years ago. We're really starting to get some traction in the USA, and I'll talk about that a little bit more. But we're now the number 9 brand in the USA, and we're one of the top processors of olive oil, processors and growers of olive oil in the United States. Bega over the top anyway. Definitely not Bega's results. Sorry, not $3 billion of revenue, but we'll get there.
Projections.
So we announced our half-year results a couple of weeks ago, and I just want to quickly touch on that. I think for the half year, we continue to see really strong demand for really high value, locally produced extra virgin olive oil, and both here in Australia and in the USA. And that really drove our result for the half year. Importantly for us, most of our growth came through, all of our growth, through packaged goods sales. So around 90% of our revenue comes from branded and private label sales, the majority branded. We saw over 20% growth in our Australian packaged goods business. I'll talk about that in coming slides. And the USA, around 18.5% growth for the half. From a profit perspective, so we reported an increase in profit up to 14.5% EBITDA, which is up 75%. Cash flow from operations, I'll talk about that in a little bit, how that differs from, or why that differs from profit, of $43.6 million. From a after-tax perspective, we reported a loss of $4.5 million. And I think I'll just take this chance to explain sort of what happens at half year for us. So unfortunately, we have to abide by the accounting standards, and one of those standards requires you to measure the fair value of your crop. At half year, despite the fact we've got olives on the trees, we don't take any gain in relation to that crop. We take it all in the second half of the year, so in the June half. And just as a reminder, how we do that is you have to estimate the value of the oil, or the fair value or expected selling price. We then deduct the actual cost of selling, and that difference is taken to our profit and loss. And then our inventory or our oil sits on our balance sheet, and then as we sell it, it goes through our cost of sales. So the sort of key takeout there is that the majority of our profit will come in the second half of the financial year, after we've finished harvesting our crop. From a cash flow perspective, though, it's much more consistent than profit, and the reason for this is how we sell our oil. So olives are naturally biennial bearing, which means that you'll typically get a higher cropping year, like we are this year, followed by a low cropping year. And what that means is your statutory or your reported profit goes up and down. but our customers require oil consistently month in, month out, and there's really no seasonality. So the way we do that is we manage our oil or our inventory over 24 months. So for a big cropping year, like we're about to come into, we'll actually supply the market for up to 16 months, and then a smaller cropping year will supply the market for around 8 months. And what that means is our sales are very, very consistent month in, month out and growing. And it also means that our operating cash flow is a lot more consistent. And as you see from the chart at the bottom right, this is the last 5 halves, we're consistently increasing our operating cash flow, and really a function of growing supply as our trees mature, and also as we continue to add value to the oil that we sell. Just a quick overview of our Australian packaged goods sales. So we saw growth of 23% for Australian packaged goods sales, or branded growth, sorry, of 23%. The chart here, the purple bar is our branded sales, so Cobram Estate and Red Island, and the green part is private label. Most of the growth we saw through the Australian sales was on margin. We've got this situation where we're actually constrained by supply, so we're unfortunately having to ration all our customers olive oil, which is not a position we want to be in. But we've got a lot of supply coming on. I'll take you through a slide on that, so we're certainly looking forward to that. From a US perspective, we're really starting to get some great traction with our brand. Our branded growth was 83% in the half, which we're really happy with. And sales, packaged goods sales of just under 24 million Australian dollars. The growth in branded sales came from a number of different points. Really, we continue to increase distribution. We're seeing better turn rates, so the products sold at same store type sales rates. And there was some price increase during the half. So the combination of all three have led to a significant increase in branded sales for the half. We're in most of the top 10 retailers. There's a couple of big box retailers we're not in the USA. Over 18,000 stores. Still obviously huge upside in that. And as I said in the opening slide, we're the number 9 brand, olive oil brand in the USA, and the number 2 Californian brand. This slide is really just shows the assets that we own, which is just under $900 million. And I think for us, why that's important. All the oil, pretty much all the oil we sell comes from our own groves, and that's really developed over time. And why that's important to us is that we're selling a really high quality product both in Australia and in the USA, and controlling that full value chain from growing the olives right through to when we bottle it and deliver it to the supermarkets has been really important to us, and has meant we've been able to really stand behind the quality that we sell. And certainly we're seeing consumers respond well to that. Just getting onto our growth strategy. So we've had 4 growth strategies for the last 10 years, and we really haven't deviated from that. But the first one was really increasing our supply from our Australian assets, so olive oil supply. The second's been growing our USA business. The third one's been increasing the value of every litre that we sell, predominantly by value adding and selling through our brands and capitalising on our sustainable growth position. But really, when it comes down to it, it's about we aim to increase supply of high quality extra virgin olive oil, predominantly through our own plantings, and add value to it as we sell it. And that's simply our strategy. So the two, just sort of flipping between the two businesses, so they're in slightly different positions. The Australian business is a lot more mature than the USA business. We've invested significantly in the Australian business. We have 7,000 hectares. We're through the CapEx phase, or the growth CapEx phase, and post 30 June we'll really move to a maintenance CapEx. But what's important to us and to investors is that 35% of our growth area is yet to reach maturity. So if you look at the average oil yield over the last 2 years, That yield will roughly double when those trees are at full maturity. So we've spent the capex, we've done the hard work, and now as the trees get older, there'll be more and more supply, which will continue to underwrite the growth in branded sales. USA is a smaller growth footprint. We started off there just by working with third-party growers, and they're an important part of our model and will continue to be. As I said, we've got over 1,000 hectares of our own groves. We're really going pretty flat out planting groves at the moment. We've just purchased land for over another 1,000 hectares that we'll plant out over the next couple of years. Where we are, we're in the Central Valley of California, so we're just out of Sacramento, about 120 kilometres from San Francisco. It's in a terrific area, and we have all our business operations within 50 k's of our processing mill. The USA, we have only 20% of our groves are mature. The rest is immature. So there's obviously a lot of growth of oil supply coming on. Similar to Australia, we're in a position now where all our oil that we mill gets sold through packaged goods channels, and we're again having to ration oil. So we're in that good position of really waiting for that growth to come on to support growth in sales. That's just a quick picture of our latest plantings, 164 hectares that we planted in the Central Valley of California. And as I said in the previous slide, that we've just purchased just over 1,000 hectares of land that we'll plant out over the next couple of years. So financial outlook for the company. So we continue to see strong trading conditions. We expect strong sales, profitability and operating cash flow into the second half of the financial year. We're continuing to invest in capex. As I said, our Australian business after this financial year will largely go to maintenance capex, and most of our capital allocation will go into the US on increasing supply or planting olive groves. This year is an on year, so we're expecting our profitability to be significantly higher than last year, and we're certainly looking forward to that, and really looking forward to starting harvest. We start harvest in 3 weeks' time, and really due to the vertical integration of our business, we'll have fresh oil on shelf by the end of April, which is great for consumers. So that's all I had. That was reasonably quick, but if there's any questions, or I hand to you, Paul.
Super impressed the way that you got through with your slides screaming Bega at you at the bottom. So that is.
I have seen them a few times, those slides. So.
John.
As your trees are maturing in Australia, do you have a depreciation cost that then becomes more significant in the orchards?
Not overly. So just to remind everyone, so we capitalise costs for the first 4.5 years, and then we depreciate the tree cost over the next 20 years. It will increase slightly, but not significantly on where we are now.
Just on through the cycles there, I think with the US diversity and the brand strength, where do you see the and on and off years? Where do you see the cyclicality going in the next 2 or 3 years?
Yeah, it's an interesting question because we have biennial bearing in the USA, so it's very confusing for investors. But operationally, it's not confusing because we're just managing oil monthly over a 2-year cycle. So we're not focused on whether it's an on or an off year. We're just focused on managing oil over 24 months, and it's exactly the same in the USA. If we could report every 24 months, we would save us a fortune in audit fees, but unfortunately we can't. So what we try and get investors to think about and focus on is really our sales, growing sales, and operating cash flow is a really good measure because it's obviously sales less costs. So but we also report on a 2-year rolling average, which takes into account off and on year. That's been an important measure for us on a statutory profit level.
You see on a 5-year view that you pretty much have to back that out because you're going to have those 2 geographies. You're going to have the operating cash flow focus and perhaps other geographies and things that you can grow into. So is that I suppose, part of the strategy is to dampen that, or are you going to lean into that volatility and say, well, we can grow better than our peers?
Yeah, I think it certainly hasn't driven the strategy, but I think as you're in different regions and different northern and southern hemisphere, and as the trees get more mature, naturally you'll get a smoothing of earnings and a smoothing of supply. But it certainly hasn't driven our strategy to go over there. It was more around we saw a terrific opportunity that the USA, only 5% of what's consumed is produced in the USA, 95% imported, which is staggering, and there's only 1 litre per capita consumed, and in Australia that was the case 10 years ago. It's now 2 litres per capita, and in Europe it's closer to 10. So we just thought it's a terrific opportunity. It was a bit of a no-brainer for us. It's been very, very hard to make it work, but certainly the last 3 years we're really pleased with where the business is going.
Couple of questions.
Yeah, Sam, I know that olive oil prices have gone ballistic the last couple of years, and I could sort of see some of why that was. I was in Italy recently and seeing kilometre after kilometre of dead trees, disease being bulldozed out. And given a lot of that American stuff comes from Europe, can you just talk a bit about the impact on supply, demand, and how much of that's driving your business?
Yeah, I think it's probably certainly the last 2 years, Spain, which produces around half the world's olive oil, they've had 2 significantly lower than average crops, which has driven a spike in commodity price for commodity oil. And the difference with our business is we don't think about it or look at it that way. We're selling high quality, locally produced fresh olive oil in both Australia and the USA. And all our research shows, and we see it, that consumers rarely switch between the two. So once they've tried fresh Australian olive oil, they love it and they don't switch back. So there's obviously some that'll buy just on price. We haven't ridden that commodity cycle. We haven't increased our prices as much as the imported products, and we think we're offering a really good value product for consumers. So we're producing high quality oil. It costs more, and so we think about it more that way, that we continue to offer a really high quality product rather than we're a commodity olive oil and we're just going to go up and down with the rest of the products. And that's the way we've looked at it for the past 10 years.
Yeah, great presentation, Sam. The obviously almonds in California, very thirsty. What is the sort of water requirements for all olive trees? And how do you feel about water security, both over there and over here?
Yeah, no, it's a good question. So I think compared to almonds, we use roughly half the water. The land we're purchasing in California has dual water source. So you've got the surface or channel water and bore water. So we see that as really, really secure sources. And in Australia, we've never had a problem getting water. Obviously, the pricing of water goes up and down in Australia. In the USA, or where we are, it's very different. So water isn't decoupled from the land. So you don't get that price volatility. But no, we're comfortable with the position. It's obviously always something that, from a risk point of view, you're worried about cost. But supply is a concern for us.
Thank you, Sam. See you on the panel. There we are. So David Surveyor. There we are. In the middle there. So we're very happy to have Select here. PAC's been with the Select team since very early on, and David has ridden a bit of a wave, but he's got the platform back on deck. So please welcome David to talk about the next phase. Thank you.
Well, thank you, and good afternoon. Obviously, pleasure to be here to talk about Select Harvets, and also like to thank you for inviting us to come and talk to everyone today. So let me just roll through some slides here. So this is a standard slide that everybody knows, so we don't need to dwell on this slide at all. I think useful perhaps to start by giving an overview of select harvests. Have we got Bega again? Yes, we have. Excellent. Paid extra to get that.
Sponsor.
So look, Australia, from an almond perspective, Australia is the second largest almond producing country in the world, and Select is a significant global player in the almond industry. And we're in an industry that operates with a positive CAGR sitting around sort of 5 to 7%. We're a vertically integrated business. Our orchards are valuable. They're long life assets in proven Australian growing regions. Our Carina West processing facility is a terrific asset. It's got primary processing, it does sorting and packing, and it also does a range of value-added products going through that facility. We're a business that's got a pretty significant path to growth, but our path to growth is really about leveraging our existing core assets, and we're starting to do that in an environment where the almond macro is becoming a really strong proposition. So I think absent of sort of the fundamental inherent vagaries of agriculture, the business is pretty well placed to be able to increase its profitability and returns as it goes forward. Now, what I'm going to do is I'm going to show you 3 operational slides today. And the reason I'm going to show them to you is because they go to the message of this is a company that's shifting performance and it's sustainably using that to change its results. So in other words, I'm going to show you 3 slides that basically say we're doing what we said that we would do. So first one here is on safety and sustainability. And so clearly for Select Harvests, people are critical to the success of the company. Our TRIFR for the full year was running at 7.1. So our injury frequency rate is step change different to any other point that has been in the history of the company. And so we're demonstrating visible leadership on safety right across the organisation. We're building better safety systems. We're reducing hazards. We're pulling down risks. We're having fewer incidents, and we're making sure that our compliance capability is going up. Now, clearly, you can't be satisfied until you're at the point of zero injury. But the point really is that the improvement that you're seeing sort of demonstrates a shift in the cadence and a shift in the operational standards and approach of Select Harvests as an organisation. Overall, in the ESG space, our carbon emissions are coming down. So if you look at per kernel tonne, we've had a 6% year-on-year improvement across our farms, or reduction in emissions, 25% reduction across our Carina West processing plant. We continue our approach to running a circular economy. So we take a chunk of our hull and shell and we put into our own cogeneration plant. And so we're generating our own energy, and rather than having to use fossil fuels in terms of the way that we operate, or lesser volumes of fossil fuels. We create about 44,000 tonnes of our own compost. We do that because it allows us to improve the soils, improve root health, and of course use less chemicals in terms of the fertilisation and looking after our trees. In terms of food safety, we've had a substantial reduction over the last year in terms of the number of food quality complaints that we've had. They've reduced to a total of 52 across the year. And from a people perspective, we've got a series of programs and policies that are really aimed around ensuring that we've got an inclusive environment in terms of the way that people operate. So similar to our safety position in terms of ESG, what we're trying to say to you is that there is a shift in our business model and a shift in the performance of the organisation. Now let me move on to talk somewhat about strategy. And the company strategy has really got sort of 4 fundamental elements. The first of those is about substantially increasing our almond volumes. The second is about leadership in processing, scale and efficiency. The third is about maximising the return that we get from the crop. And the fourth is about innovating to drive step-out growth. So what I'll do is I'll talk about our progress. I'll then connect it to our project management office and the value that's been created from doing all of this. And this year, we've made a very substantial step forward in terms of execution of our position. And I think what you can see is you can see the plans progressing. The traffic lights show our performance. The white dots are areas where they were not previous priorities and they're now moving on to our radar for action. But I think the sort of key point to be made about Select Harvests is the business is now materially different and lower costs to the business versus just 2 years ago in terms of its operation. So if I start by this on this first pillar around substantially greater almonds, we've materially increased and widened our almond base to some 40,000 tonnes. Pleasingly, our 24 crop bounced back to record levels, but the real issue is that we've got a strategy that's driving for increased yield across our farms. So we're running better practices, growing to 2-year cycles, so we won't see the improvements in this year's crop. And so similar to the on and off year discussion, variance between on and off years is smaller than it is in olives, but we do have that. 24 was an on year for us. But what we're doing is we're benchmarking our farms against others, and we're pretty confident that we're going to get more yield improvement over time as we optimise the business around application of fertiliser. We've increased bee density to reduce the flight distances that bees need to undertake. And we're also making sure we're doing work around optimising our water usage, which is interesting given the earlier comment. So when you go and look at our farms and you look at the tree health and the wood growth that's existing on those farms, it's obvious that through better practice, we've got better results that will be coming our way. And the price for doing this is really substantial. For every 1,000 tonnes of crop that you get, the incremental cost is really small in terms of the delivery of that. The other thing that we've done in the space of agriculture is we have reduced our costs overall. That said, we've improved our farming efficiency with sprays, we've improved our effective use of labour, and we've actually simplified our organisational design. The other thing that we've done in terms of the almond position is that in 2024 we had a 5-fold increase in the volume of third-party almonds that we brought into the business. So we've gone up to about 10,500 tonnes. And that brings obviously a step change in the revenue of the business, but it brings profit to the company through processing profit and through our sales and distribution profit on those volumes. And it comes without any agri risk. On a like-for-like basis, this year we will have a small increase in external third-party volumes again. In terms of our midstream business, that's changed scale as well. So across processing plants, we're seeing productivity gains in terms of costs. So we've got less line stops happening in terms of running our plants. We've got lower packaging costs. We've got lower labour costs. In 2024, we increased the plant capacity from 30,000 tonnes to 40,000 tonnes. So that's a step change in that part, in the midstream part of our business. And essentially, it's allowed us to have a balanced business as we start to have these additional third-party volumes coming through. And whilst we've had 40,000 tonnes, that's led us to the next question, which is, well, how do we get to 50,000 tonnes? And so we're now going after that the next step shift in capacity. I'll talk about that on the following slide. And whilst the conversation around our Carina West processing facility is typically about capacity, it shouldn't be missed that we've also improved the facility yield of that plant. So we've got less product damage happening on stock pads, we've got less product on the floor, we've got less chips and scratches, and we've subsequently had a 30% improvement in terms of a reduction of customer complaints going through the business. Our sales organisation is also acting differently and operating differently in terms of maximising the return from the growth. So we've expanded our customer base. We've done that so that as we increase our volume, we've got a customer base that's capable of consuming that volume. We added some 21 new substantive customers over the course of the last 12 months. We've also looked at how we can get margin advantages for Australian product against California. And in doing so, we have increased our weighting of supply into China, and we've also created some new grades that we sell. And so what we're trying to do is put as much product as we can into the highest price markets that we possibly can do. The other thing that we've done in the sales space is that we have increasingly moved to direct supply relationships with our customers. And so we're removing intermediaries from the exercise. That's allowing us to both capture more margin, but it's also allowing us to understand the customers and the markets at a deeper level. And so we increased our direct sales by about 13% of our total sales over the last year. And then the fourth priority was this issue of step-out growth. And I think the reality is, and sort of relating to the way that Paul introduced the business, we've got a real focus just on getting our existing base business into the right shape. So we're only very opportunistically looking at sort of step-out growth. So we've got some activity, for example, happening right now about how we expand our compost proposition, and we think about the way that we might deal with and sell compost material to the company. But really, what we're doing is very opportunistic in that space. So we've got no M&A activity going on, and we have no immediate plans for any M&A activity. So the focus really is about the existing operation, and we think there's a massive amount of leverage out of the existing base business as we get it into shape and get it operating as it should. So this is the sort of second operational slide that I wanted to put up. So this is about Project Optimus. So we're right in the middle of executing this next low-cost step to create another 10,000 tonnes of capacity for an MS processing facility. So we did a capital raise last year. We've taken $5 million of that capital raise, and we're investing it in this capacity expansion. And now this is the second phase of activity. So phase one, 10,000 tonnes in 2024, and this is another 10,000 tonnes which we've committed will be operational by 2026. So the end result is you have a business that moves from a 30,000 tonne business to a 50,000 tonne business. And ultimately for our shareholders, what it will mean is that we've effectively built a new plant. A new plant will probably cost you in the vicinity of $100 million. We will have built effectively a new plant's worth of capacity for about $6 million worth of investment. The slide talks to the two phases with Project Optimus. I won't go through the detail of that, but the point to be made is we committed that Optimus would be ready in 2026. We said that we would gun to get some of that early if we could, and we've now got phase one operational. So we're ahead of plan and we're running our plant faster. Last night we ran our plant at 10.9 tonnes per hour. So we're getting a step shift in capacity as we're sitting here today. So we're delivering what we said that we would do. This is the third operational slide I was going to show you, and it really just shows you our portfolio of farms. It says that fundamentally our farms are operating in their sweet spot in terms of the age of those farms, and that should continue for quite some period going forward. We're equally quite conscious of the fact that some of our historic approach to farming had been driven by cost, and clearly that's an important thing to be focused on, but it hadn't considered yield, or at least hadn't considered it well enough. And so we've seen crop performances that were perhaps lower than they could have been, and hence our strategy for improving yield as we manage forward. The company's also continually investing in improving its farming operations. We've recently invested in additional drainage at our Triangle farm. We've got a sensible replant strategy happening. We put 69 hectares replanting into our Jubilee farm. Last year, we've got another 12 hectares to go at our Mount View farm, which is sort of some cleanup from trees that were lost during the 2022 flood. There's no doubt when we look at our New South Wales farms, we need to see some recovery of those farms. They've been inundated with rain over the last 4 years. The trees have got wet feet in essence. And so, that's had some impact on the health and yield of those farms. Fundamentally, our farming position, we're getting more efficient, we're getting more cost effective in the way we're operating, and we will get improved yields. Now, the way that we set the operational cadence for the business is that we run a project management office. We use that to drive our outcomes. We started the year with some 47 ongoing projects. In the 2024 year, we created $33 million of incremental value to the company as a result of those projects. But I always make the observation that you should offset that against, and I've sort of heard it in the room already, but the inflationary pressures that every single Australian business faces. And so net of all of that, we'd say that the value last year was about $15 million. If you go into the year that we're in, and get more forward-facing, we continue to identify new opportunities and new projects, and we've delivered some $11 million worth of value in this financial. Oops, too fast. On the left-hand side has suddenly got coloured in. It's curious. It doesn't say Bega at least, but it's been coloured in. So what this slide would do properly, if you could read it, and it wasn't covered, was really starts to talk about the global supply and demand dynamics for almonds. The balance is substantially improving, and the long-term global economic macro for almonds is looking very, very positive. So on the supply side, what we've seen in the US, is sort of 80% of world's total almond volumes. We've seen US acreage reducing over each of the last 3 years. So total acreage is sitting at around 1.5 million acres. About 1.4 million of those acres are bearing. We think bearing acres have clearly peaked in the US. There's acreage being pulled out. It's been being pulled out because the economics have not been good for the previous 4 or 5 years for almonds. The objective forecast for almonds over the last year was a 2.8 billion pound crop. The crop size is going to come in under that. It's looking like it'll be about 2.68 to 2.7 billion pounds for the year that we're in. And the recent 2025 US bloom has seen some pretty variable weather. There have also been some examples of bee colony deaths that have happened in the US. And so we think the carry-in volumes will be below 500 million pounds, which was this year's number. So we think it'll be 400 and something range million pounds as we go into the coming season. That will be good for prices. From an Australian perspective, the Australian Almond Board has reduced its forecast around where it thinks the total volume of Australian almonds will be. I think sort of a 5-year long-term position, we'll be at 173,000 tonnes. It's about 150 or so last year. And from a select harvest perspective, our forecast for this year remains, as we've publicly put it out there, in the sort of 29,000 to 27,500 range. That said, what it will be, we need to wait and see what comes across the weigh bridges, and that'll give us a true sense of what's coming. And we don't quite know the answer to that, although harvest has started. On the demand side, consumption, as I mentioned, CAGR earlier on, that continues pretty positive. We've forecast a price of $9.20 per kg. That remains our current forecast. I'd also mentioned we've increasingly tilted our supply towards China to maximise our price, increase direct supply, and make sure that we've got some very customer-specific grades that we're putting to the market to try and optimise our price position. Right now, we're experiencing the next sort of fundamental surge in demand. To quote both India and China, to quote my GM sales from this morning when I caught up with him, he said, "It is going nuts." I'm not sure the pun was intended, but nonetheless, that's what he had to say. We're also seeing some interesting things happen in terms of the China response to the Trump tariffs. So China has put on an additional 10% tariff charge for nuts out of the US. That will be helpful for price. Overnight, we see the EU is also talking about retaliatory tariffs, and the number that's rumoured for that is about 25%. So our view is prices going up, there's more price to come. We think our view on price has been borne out over the last 6 months, and we think we're in for a journey now with the next several years with a very strong pricing position. So I think when you look at the business, we'd say that we've got significant and demonstrable progress in terms of our transformation exercises. The net gain in value has been substantive. As we've consistently said, our focus is about growing, processing and selling as efficiently as we can. And the leverage in this business comes from things that we can do organically. We do not have any large capital spends coming up, and there are really 5 things that are driving us forward. It's capture as much price as you can out of the marketplace. It's maximise our yields and also profitably add third-party supply. It's expand our midstream. The profit earnings of that are quite compelling. It's continue our PMO to make sure that that's delivering outcomes and make sure that we stay at the right end of the cost curve. We've got a little bit of work to do around our back office. As we clean that up, we think that'll help us accelerate our position. So you've got a business that effectively costs are coming down, almond volumes are going up, processing capacity is going up, sales capability is going up, and it's happening in an environment with really strong positive prices. So there's a lot of leverage that we think will come through.
Rousing into the presentation.
Indeed.
So, I can see what you think about share price. Now, my quick question before we go to Nufarm. I think it's probably worthwhile because you've been in the chair now for what, 2.5 years? Yeah. So obviously, take away, I suppose, the disappointment of the first harvest and things. Is everything else sort of in reasonable shape going forward now? You think you've righted the ship and this is I suppose the path that we're on?
I think that's so I think the answer is yes to that. But I don't think the business escapes the fact that we have the vagaries of the sun and the weather and the rain. And so what the gods deliver us, that's always a question mark around this business. But I think if you went to the things which the company can fundamentally, and same with water prices as well, by the way, or fertiliser prices. Again, those probably sit into some of the uncontrolled. But I think if you said, have we got a program that, if you looked across those key functional areas, have we got a program across horticulture that you can believe in and that looks like it will? Yes, we do. So I think there's more work to do, there's more opportunity and so on. If you looked at our processing plant, I think that's kind of almost been the star performer of the changes and shifts that we've made. I think we've unlocked and we continue to unlock capability in that space. I've got no doubt in my mind that our ability to run a processing plant is better than any of the other processes. I'll say that as modestly as I possibly can, but I'm pretty confident in that space. And then I think our sales organisation is on the journey to increase maturity. I don't think we're in the mature space from a sales perspective yet. I think there's a lot more to be done. And I think broadly speaking, if I went out of select to an Australian position on almonds, I think the sales and marketing of almonds has been pretty much a commodity approach to the world. I don't think we've done a very good job really about realising points of difference. So I think Cobram becomes a really interesting example or leader perhaps in that space, as in fact does Bega in terms of the way that they think about the world. Because the sales and marketing of our industry has been very much more about the selling and less about the marketing and positioning. I think that's the opportunity that sits in front of all of us.
Thank you very much. And we'll come back for the panel as well. We appreciate it. And having a quick change of computers here, we're trying to. We love Bega, but maybe presentation.
Got me.
I'll introduce Rachel. I've been bumping into Rachel for years at conferences, and it's in the seeds area of Nufarm. And each time we say to Rachel, it would be great for the seeds to be prominent in the presentation that we do at the AgFood PAC result, and we've finally got it all happening.
Finally snared me. Huh?
And similar to Adrian with Nutrient, each time he talks to you, get promoted. So now you're basically the global head of the juggernaut. So here we go.
I actually did our executive MBA together, so there you go. So thanks for the opportunity to come. And yes, I'm finally here, Paul. And for those of you that I haven't had the pleasure of meeting, my name's Rachel Palumbo, and I'm the Global General Manager of Seeds for Nufarm. And just to give you a sense of where I fit in, because Nufarm has our crop protection business and we have our seeds platform, and our seeds platform has a few different components. And the role that I play is that I lead our regional teams worldwide that really drive the adoption of our new seed varieties, as well as the contracts that we do at a grower level. So my colleagues take care more around the oils side of our business. And so there's been a theme of oils coming through this afternoon, but they focus more on beyond that farm gate piece. So I'm going to talk a little bit more about what happens behind the farm gate. And on the slide, you'll notice that there's no Bega logo, but in fact, you'll notice an evolution of our brand and a new visual identity for Nufarm. And we've really streamlined this to make it easier for our customers to connect with us. So historically, we had Nufarm and Nuseed. You'll see that all coming together under Nufarm. And it's really to better demonstrate the breadth of our offerings and to understand that the seeds is a really integral part of what we do at Nufarm. And this update really to the brand identity helps us to strengthen that commitment across our entire portfolio and really make the brand accessible to all of our customers. So it's with a pleasure and that you get to see that today. And actually, it's quite new. So it'll come out to the market late Wednesday. Now, there you go. So you're getting a sneak preview, everyone. There you go. So throughout my career in agriculture, I've had the opportunity to focus on bringing innovation to farmers, and they're the folks that really bring this all to life. And we don't have a business without our growers. And our industry is really one that's marked by resilience, adaptation, forward thinking, And I get the privilege to witness this firsthand around the world and work with our Nufarm team, growers, agronomists, and our industry leaders as we work towards overcoming global challenges and really unlocking new opportunities through plant science. So the best solutions that we have at Nufarm don't come from the boardroom in Laverton. They come from the paddocks around the world and the people who live and breathe what we do each day. And so I really wanted to share with you a little bit about that story outside of Australia. And I'm going to talk about our seeds business in South America. It probably is something that you're less familiar with. And I've done something here to the presentation, so I'll try and fix that. It's all working again. There we go. And I'm going to tell you a little bit about that solid growth journey that we've had in South America. And you're probably wondering, well, why is South America important to Nufarm and why is it important to seed? Well, since our inception of our seeds business in South America, our EBIT contribution there has grown 12 times. So it's a remarkable expansion since 2016, and it really highlights the growth of our operations as well as the growing importance of South America as a region for Nufarm seeds. And as we see global demand continuing to increase for seeds, for vegetable oils and bioenergy, we see South America really positioned as a major player in canola, sorghum and sunflower, which are really key markets and growth opportunities for us. And so through some of the strategic initiatives, the technological advancements, our strong market development efforts, we're really establishing Nufarm as the leader in the seed space there. And I want to take you through this journey and our presence in Argentina, Uruguay and Brazil, and explore about how we're actually working towards some future growth opportunities in that market. So we've built a pretty strong presence in, okay, we're going to go with that one and with this one. There we go.
Little clicker.
I tried the clicker, it didn't work. No, this cleaver. There we go. We're here. We're back on. So if we think about our journey in Argentina, it started a decade ago in a place called San Carlos, which is in Santa Fe, and it initially focused on sorghum. And since then, we've expanded our Argentinian business to include sunflowers, canola, and carinata. And I'll talk a little bit about what carinata is later. Over the past 4 years, our Argentinian operations have tripled in production volume, and that's been really driven by new product introductions as we've improved our breeding and launched new products to the market, as well as expanded our distribution network. And our success in Argentina is driven by a real dedicated, deep connection with customer relationships and a really deep, dedicated team that have really been with us since the beginning there. And so it's really demonstrating our long-term commitment to that market. We just made a recent acquisition last year in Uruguay, and that's actually further strengthened our footprint in the region. And it's particularly important to canola and carinata as an opportunity as we continue to grow our South American strategy. Move this one this way. So if we look at Uruguay, it's really becoming a key canola producing region, and it's benefiting from really fertile soils and a well-established double cropping system. So farmers in Uruguay typically grow soybeans, and in the summer they're rotating with winter crops like canola. And what we're seeing is that canola production will be on the rise in Uruguay. And that's really supported by the continued expansion of sustainable agricultural practices and growing demand from both domestic and international markets, and this potential for a growth in the canola sector there. And we see that from a winter cropping perspective, there's a strong growth there. So the USDA are saying that in 2024, there was around 742,000 hectares of winter cropping production, and that there's potential for that to grow, and there's potential for canola to be over a third of that. So if you think about why that's important to Nufarm, in Australia, every second hectare of canola is planted to our genetics, and so we have a strong ability to be able to leverage our global breeding program that is based in Horsham into markets like Uruguay, Argentina and Brazil. Sorghum's another crop that we're really focused on, and it's a significant one in Argentina. And if you think about the opportunity there, we're seeing continued growth for Argentina, and it's positioning itself as a global export in the global export market. And there's been some recent announcements about the favourable trade into China from that perspective. And so we're really increasing the adoption of advanced agronomic practices and high-yielding varieties, that it's improving the production of sorghum in those markets. So according to the USDA, Argentina's sorghum cultivation reached approximately 623,000 hectares in 23-24, and for the 24-25 season, that area is projected to increase to 850,000 hectares. And we're seeing that sorghum will continue to grow with an expectation of a CAGR of around 6.7% from 25 to 30. And so this is really driven by the demand for sorghum, both domestically and internationally. And these, as I mentioned earlier, these favourable trade policies are driving international demand. And our breeding program has nurseries both in Argentina and US. So we have quite a strong global footprint in sorghum. And we're developing new varieties that help growers with drought resistance, with yield potential and disease resistance. And we're also ensuring that these varieties are able to fit in multiple markets as we're thinking about the expansion there. And so if you think about what else our program has to deliver, in the 24-25 season, we're actually going to introduce our first sorghum hybrids with herbicide tolerance. So they'll have a tolerance to IMI. That might not mean much to everyone in the room, but it's an important herbicide used for growers. And this represents a significant value increase, both for Nufarm in terms of a seed margin perspective, but also for growers in terms of the value of the crop. So we're quite excited that that will soon extend across our broader portfolio, including our silage and grazing varieties. The other area of Argentina, which is important to focus on, is sunflowers. And so sunflowers play a really important role in Argentina's landscape. And Argentina is one of the leading producers of sunflower oil. So again, we're able to bring the latest breeding technologies there and continue to work with our partners in Argentina to strengthen their position in the global sunflower market. And if you look at some of the statistics around the size of the market there, Argentina's sunflower area for 23-24 was approximately 1.84 million hectares, and it's projected to increase to 1.95 million hectares this season. And if you look at what the projection says, it's against the average is about a 5% increase there. So I think that is showing again the continued growth of Argentina in that space, and us well positioned to service that. But if I think about South America, what excites me most from a seeds perspective at Nufarm is actually Brazil. And in recent years, we've really built a significant presence in Brazil, and we've been tailoring our seed portfolio to the country's very diverse agricultural environments. And we've got a headquarters in Curitiba and a production and seed distribution facility in Acruna. And we made an acquisition in 2017 of a business called Atlantica, and that provided us with a good foothold and a basis on which to grow our business from. And so we inherited an established administration, sales, marketing, production, and I guess variety testing network. And we're well positioned to continue to expand our reach in that market. So one of the areas that is of great interest to us is actually canola production in Brazil. It's still in its really early stages, but the potential for growth is pretty significant. Traditionally, canola hasn't been cultivated in Brazil, and that's really been due to the dominance of soybean production. However, as we're seeing an increase in demand for vegetable oil specifically, and going into biodiesel, canolas really are gaining opportunity there and recognition as as a complementary oilseed into the system. And so canola cultivation in Brazil is actually concentrated in the south, in Rio Grande do Sul, and it's got really good conditions for that production there. So as of 2024, the state there allocated 7,000 hectares for summer crops and 2 million hectares for winter crops. And so canola is considered as a really viable option to fit into this state and into their system. And that's due to the low production costs in the region. And it also has favourable phytosanitary conditions compared to other winter crops like wheat. So if you look at Brazil's production today, it's actually still quite modest. So in 23-24, the production was around 215,000 metric tonnes, and that was an increase from the year prior. But there's real concerted effort to expand the cultivation, and there's initiatives like Ready Canola aiming to promote canola farming actually in Brazil. And so Nufarm, we're actively involved in developing the market with a number of channel partners in that space. And this initiative is focused on how do we actually promote and expand the cultivation. And this is really trying to focus on what are the things that we need to overcome to help growers help growers to adopt the crop, but also increase the area planted to canola. And it really drives crop diversity, which is one of the key reasons that there's a lot of support in the industry to drive this forward. It gives local growers a greater competitive advantage, and it enables them to capitalise on both the local and global demand for canola. So our internal projections indicate that Brazil could reach around 1 million hectares of canola cultivation in the next 5 years, and that's from a basis of 180,000 hectares last year, and in the 5 years prior that was 40,000 hectares. So just to give you an idea, we're really focused on how do we kind of capture that opportunity, and we're able to leverage that strong Australian breeding program that I spoke about earlier to introduce high performing varieties that will be really suited to the local climatic and soil conditions. Another opportunity, if you think about canola, is its role in biofuel. So a significant portion of Australian canola actually goes to Europe to help decarbonise Europe's roads. And if you think about Brazil, they're leaders in biofuel. In 23-24 of the soybean area, so it's approximately 45 million hectares in Brazil, soybeans actually play a really important role in biodiesel production, and soybean oil accounts for about 69% of the feedstock used in 2023 in Brazil for bio-oil. So if you think about that, that's consuming about 35 million tonnes per year. And so while soybeans really, I guess, dominate that biodiesel sector, there's potential for other oil seeds like canola to contribute more significantly. And this presents a future opportunity for crops like canola. The sorghum story doesn't end in Argentina though. Brazil is actually a really important sorghum market, and there's cultivation that's expanded over the last, well, since 2017, the expansion has been from 1 million to 2 million hectares. And sorghum's kind of, it's like a second crop following soybeans. So it provides a sustainable and a cost-effective option and alternative to corn for Brazilian farmers, and projections are looking at further growth in that area. So we're expecting about 2.4 million hectares in coming seasons. And if we look as well at the global trade dynamics for Brazil, there was a very recent approval of Brazilian sorghum exports to China, and that's expected to boost further demand. And so at Nufarm, we've actually built one of the most extensive sorghum portfolios globally, and we're able to access new markets through new traits that we're introducing around insect and herbicide tolerance in our kind of conventional breeding standards. And that's really supporting Brazilian farmers as they're looking to optimise yields and profitability. Another adjacent sector there, which is interesting, is the corn ethanol industry, which is relatively new in Brazil, and it's experienced significant growth over the past 8 years, and it continues to expand. So it presents an opportunity for sorghum, and the why is, if you think about it, there's currently about 25 million tonnes of corn that are used for ethanol production, and total sorghum production in Brazil is about 7 million tonnes. So if just a small percentage of that corn demand shifts to sorghum, we would see a significant increase in sorghum demand, and that would create new market opportunities and position sorghum as an alternative in the biofuels sector. So an interesting element to watch there. Some of you, yeah.
If you want some questions, we need to
move. Yeah, this is the last piece around Carinata, so we'll close that down. So I'm not sure how many of you have heard of Carinata, but it's really a game-changing opportunity for sustainable agriculture, and has a role that it plays in South America. So since 2019, we've cultivated Carinata in Argentina, and it's a non-food oilseed cover crop, and it's used in biofuel production. So we have a 10-year offtake agreement with Carinata with BP, and we have a commitment around how we drive the sustainability and traceability of Carinata production in the market, and we are growing that predominantly in South America today, and then we manage those logistics and exports and process that in Europe for biofuel use there into SAF as well as biodiesel. So in Brazil, we see this as a future opportunity, and Brazil is really set to be a major player in Carinata production into the future. So I think that just gives you a bit of a view to some of the technologies that we have in seeds, and a little known area of South America that's contributing strong results to our business.
Just a quick question there. You talked some strong results for the group. So seeds is the standout growth in Nufarm. It must be a bit hard when you see those half-year and full-year results, and seeds are supposed to bounce up in the next 3 or 4 years. So how confident are you that the building blocks are there for that growth?
Yeah, and I think it's an interesting question. Our base seeds and traditional seeds business is really hitting its straps. We've had really strong results in Australia and in South America, and we're also in a real market development phase with our oils platforms when you think about bioenergy and you think about nutritionals. So when you're looking at our results, you're looking at all of that combined.
Yeah. You've got some stretch targets there, so we're really looking forward to achieving those, and thank you very much for coming on today, Rachel. We will be in the panel shortly. Just welcoming up the best thing about being the last presenter, Paul, Serra from SunRice, is you become the first speaker next year. So there we go. So we're very happy to have Paul Serra here. We've been spending with SunRice for a number of years, and it's fantastic they're attracted a person like you to head it up for the next phase. There's a few issues with the grower AB shares we'll talk about later, but the platform is fantastic and the opportunity is immense. Thank you.
Thanks, Paul. I thought it was just saving the best till last, but we'll move on. So just quickly, an important disclosure about our structure. You can find this online. We won't dwell on it too much. So talking about SunRice and what we are, we really are a diversified global food company now. Our purpose is, with rice at our heart, we bring people together through inspiring and delicious food. And, I think I'll show you in a second that over 70% of our products are branded products, and increasingly differentiated branded products out of our traditional rice or microwave rice that you see here in Australia. We're also a proud participant of the United Nations Global Compact. So this slide, I think, is quite a good one to represent what SunRice is, and the products on the right are all of our products. So I think about it in 2 ways. The products that we sell here in Australia, we're quite diversified away from core rice. So we obviously started over 75 years ago as a cooperative. We've moved through a journey onto the NSX and now onto the ASX, and we'll talk about some of our performance. But really what we do is sell branded food products around the world. We're the #1 rice here in Australia. We're the #1 through most of the Pacific. We're the #1 medium grain rice through most of the Middle East, and we have a significant presence in the US. So we have really strong branded presence. We don't do private label. I know the Bega and dairy, it's different dynamics in rice. We certainly stay away from private label. We focus 100% on our branded products. In Australia, we have diversified away from rice, as I said, into things such as pizza bases, pickled olives, anchovies, dog and cat food, as well as our equine and ruminant feed businesses here in Australia. So originally quite diversified away from the Australian crop in Australia, and then more increasingly diversified globally. And we'll talk a little bit about how that plays into our strategy and where we see the future going for the company. In terms of our revenues and earnings per share, they're in line with guidance. So we've had 3 really good years of growth, which you'll see. We've translated that through into the EPS and increase in our dividends and a very strong TSR over the past 10 years. And we certainly see some challenges, in the global context that we're facing at the moment, but also a lot of opportunities. And so we're very much in line with where we thought we'd be in sales, whilst growing our EBITDA margins and growing our overall margins as a business. As I said, we're 75 years old. I think it's really important, whilst our journey on the ASX started in 2019, our journey as a company is 75 years old. We've never had a loss in that 75-year history, and we've had a very strong performance of delivering shareholder return, and we'll talk through that. It's also the 100-year anniversary this year of growing rice in Australia. So 2 big milestones for the Australian side of our business this year. We listed onto the NSX in 2007, and then onto the ASX with our dual class structure in 2019. And they were really 2 of the key points that I wanted to call out on this slide. Now, given the focus of this forum is investing through the cycles, I think SunRice is a great example of looking at cycles and how it impacts your business and being able to diversify away from those and really shore up your earnings to be more consistent. So up until about 12 to 15 years ago, SunRice existed predominantly to market the Australian rice crop around the world. Through water reform and ongoing climate cycles, the availability of water for growing rice in the riverina has become more expensive and more volatile. And so SunRice has really diversified its earnings through initially the brand food products in Australia, and then increasingly more branded products internationally. And today, where we sit, and we'll go through this in the coming slides, we've got a very well diversified supply chain that can link to our consumer branded products around the world, that lead to far less volatility in our earnings profile, because we're far less linked to the Australian crop. Now, obviously for our Australian growers and our A-class shareholders, the Australian crop is very important. But from a dividend or from an EPS and from an earnings perspective, it's less so than it ever was, and becoming even less so moving forward, as you'll see in the upcoming slides. So whilst we don't have an updated slide here in our 2030 growth strategy, and we have spoken about that previously, I will sort of dwell on this slide for a little bit. So we're between 50 to 60% of our revenue generated internationally, depending on the year. Our first half was 53% generated outside of Australia. There is some seasonality to that number, but it's between 50 to 60%. And our strategy is to continue to grow very strong positions internationally, particularly in the Middle East and in the US, in our branded position. And what we see over time is that branded percentage sale of our company has moved, obviously, from what was quite a bulk commodity traded business 10, 15 years ago into what is predominantly a branded sales business. The majority of our non-branded business are bulk tenders or bulk government trades into Japan from our mill in California. So the vast majority of our earnings are coming from our branded business, and that's certainly where all of our efforts are focused in behind. We have over 1,500 products, 45 brands, 50 countries, and we have operations in over 10 countries globally. We have mills here in Australia. We have a small mill in Papua New Guinea. We have a mill in Vietnam and in California, and increasingly more complex supply chains coming out of South America. So we'll talk a little bit about that now. When we think about investing through the cycles, I said earlier that rewind 10 or 15 years ago, this company was very focused on selling the Australian rice crop. It's now between 20 to 30% of our annual rice marketed globally. And remember, pretty much all of this is into rice or rice-related products, whether it be rice cakes, protein chips, meal solutions like risottos, and just add chicken. More and more of our products are going towards that side of our business. and less of the rice used in those products is coming from Australia. That's not because Australia is not important to us. It's absolutely core to who we are, to our heritage, and indeed to our A-class shareholders. But with ongoing water reform, with the ongoing nature of water availability in the riverina, the reality is that our supply chains need to be increasingly more complex in order for us to be agnostic of any particular weather event or any particular growing region around the world. And that's certainly where, from a supply perspective, we're working really hard on. That needs to match, though, to our consumer business. And very much when you think about consumer businesses here in Australia, the Middle East, or the US, rice is consumed as part of a meal. That meal determines what type of rice is produced. Australia is very good at producing sushi-style rice or Japonic or a medium grain rice, as we call it. But if you're going to eat an Indian dish or a Thai dish, you're not going to eat the rice that's predominantly grown in Australia. And so we source from countries around the world all the different kinds of varietals of rice needed for our consumers to enjoy at their lunch or dinner table predominantly. And you can see here the countries that we currently source from. It does vary year to year depending on growing and weather conditions around the world. So what does that translate to for the company? You can see on this slide, we've had quite a consistent, what we're trying to demonstrate on this slide really is that over a long period of time, we've not only been able to grow top line quite significantly, particularly in the last few years, but we've done that in spite of the fact that the Australian crop has been declining. And that's due to the fact that we've been able to source, and we do source globally and a lot from outside of Australia. And then, as a result of that, our dividends and our earnings has become far less reliant upon the Australian weather conditions and the availability of water in the riverina. And so I said, whilst it's still important to the Australian growers, from a company perspective, we've not only been able to decouple that from our earnings profile significantly, but also grow our business outside of the Australian crop quite significantly. And so that those branded positions I spoke about earlier in the Middle East and in the US predominantly are providing a large amount of growth for us. In addition, we see a lot of growth coming from Australia. So most of my life has been spent in consumer goods, and I'm going to talk a little bit about that for a second. So in Australia, on average, across Australia, there's only one rice meal consumed per week in an average Australian household. Now that varies wildly because the demographics of Australia are changing rapidly and certainly becoming more of Asian descent, and therefore rice is increasing in Australia. But on average, most Australians cook between 8 to 12 meals. That's all they know. They cycle through that repertoire. At the moment, only one of those meals is rice. And so we're working very hard, and we see an opportunity to significantly increase rice consumption in Australia by unlocking value drivers, but also by unlocking convenience drivers for the consumer at home. And so we see a lot of growth to come from Australia that will be sourced from wherever it needs to be sourced from to meet that growth. And with our global supply chains, we can increasingly do more of that. Sustainability is very important and core to who we are as a company. SunRice, more than most companies, I think, in this room, being impacted by weather, the cyclicality of weather, as well as the government policies around water reform in Australia. And so we've had to focus very heavily on water productivity for a long time. So seed and the IP that we own around seed globally and the farming practices that we help our farmers grow with, not just here in Australia, but also in Vietnam and California and other parts of the world where we support our growers, is leading to the highest yields with the least amount of water globally for medium grain rice. And we're in the process now of validating, we're in a second year of validating a double peer reviewed process that'll show the Australian rice industry is up to 87% less methane and carbon emissions than sort of ponded rice, which is how the vast majority of rice is grown globally. So very strong sustainability credentials, very strong research programs behind this, and we're taking this Australian farming practices and knowledges and applying them to our other global supply chains. We've also recently had our SBTI targets validated, and so you can see here on the page the targets that we've signed up to, both near term and long term. I mentioned earlier about the returns, so this is looking back through the journey, firstly on the NSX and then from 2019 onwards on the ASX. We've had a strong history of performance. That performance has accelerated recently as we've been able to grow the company, decouple from the Australian volatility in terms of the rice crop, and increasingly differentiated branded products to be even higher EBITDA or higher net margins for the business. And that's really helping drive a lot of growth in terms of returns for shareholders. We see a lot more growth coming as a result of our strategies as well. Just quickly in terms of an outlook, so the group is expected to progress along the outlook that we've previously expressed. So we largely expect our full year net sale results to be in line with the call outs we've had previously. And we continue to see the quality of earnings and the increase in our margin profile flowing through for the rest of this year as well. And I think all of that's been driven by our focus on branded businesses. The 30% that's bulk traded is dependent on global commodity prices a little bit, and those have been down. We've more than offset though that in terms of at an earnings level by focusing on our differentiated branded products, and that's driving a really good return for the business. Just quickly on the Australian rice pool and the Australian crop, we are in the middle of a harvest. We've just started, and we do expect a good harvest this year. It's been good growing conditions, although somewhat dry, so a lot of water used at the end of the crop. But in terms of last year's crop, we have updated the pool price range from 385 to 415. And for this year's crop that we're harvesting, we've come out with an opening pool range of 380 to 450. And they're really a factor of a lot of competing elements across the globe. Commodity prices are down. Some of the mill out rates from last year's crop was impacting the overall return for growers. But it doesn't impact the profit side of the business or the earnings as much for us, because a lot of that's been decoupled into the pool. So really, I'll end there so we have plenty of time for questions, and we can get on with the panel.
Well, Mark, thanks for the punchy presentation. It was excellent. I think if you do a bit of a straw poll across Australia, I don't think many people would know the global success of SunRice. Most people just pick it up and think it's maybe an Australian brand, but they don't know what it is. So it's a fantastic story, and we need more of them on the ASX. We'll work on that one. Any questions from the audience before just going to fire away a bit? I think the one obvious one that we need to go through is the pool, and I think the pool selling, I think mid next year it runs off, and with all the momentum you've done and all the work you've done suggests that it's going to be less of a problem than perhaps it would have been 10 years ago. So could you just walk that one through?
Yeah, Paul, I think what you're referring to is we were essentially the sole and single desk for marketing rice crop outside of Australia. So we were the last single desk for export of rice. It has been free and open in Australian borders now for a long period of time. So I think as the New South Wales government presented their plan to partially deregulate the industry last year, we just thought it was much better for our company and for our shareholders that we move out of that regulated environment into a deregulated environment. So that ends actually in July of this year. So this will be the crop that's been harvested at the moment will be the last crop that's covered under that. But we see this as a net positive for us and for the industry, being able to better, Australian rice is expensive to grow because of the water price inputs into it versus globally rice. And so we have to market that to the most premium markets. And there is a limit to how many of those markets we can find and pay the growers what they need to be able to pay for the input costs. So matching supply and demand to our premium branded products around the world, I think is a net benefit for growers and for the company.
I'd love to rewind that discussion, because when the single desk was lost from all the grain guys, they were complaining like we have tomorrow. So this is a sea change.
It is, yeah. And we can talk a lot on it as to the differences between what our business model versus the business models of where the grains were at that point of deregulation. But yes, it's a fascinating conversation.
It is. All right. And the final quick one is on innovation, because a lot of the other food groups, Bega and others, have a lot of time into that innovation side. So how do you capture that innovation within the SunRice group?
We look at it through a classic consumer lens. So we look at what is the human behaviour trying to change to drive consumption growth in your brands. And so for us, a great example of that recently was the launch of our protein chips. So they're giving you 10 grams of protein per serve and come in at less calories than a Dorito with, I think, a much better flavour. And that works through a process of first a usage study across consumer markets and then working backwards to say what are the product platforms that are best going to help you unlock that consumer behaviour, and then sort of working back into your supply chains to deliver the products. With many good examples of those.
I've got them in my cupboard.
Many more to come as well.
That's good. They like the convenient food. Okay, so this is the last panel, and again, the benefit of being the last speaker is you get to stand up and be very strongly.
Sit so many hours a day.
Okay, I've got a stand up desk, so it's good. So we've got some very learned people in the room here, and we've got what I think are the top leading branded players and great in almonds and obviously seeds. So please fire away, because we don't get these opportunities very much. I can talk all day, but you probably had enough of me. Right. There we go, Stephen.
But just on the rice crop, we're
Steve, there's a microphone.
on the rice crop, we're always, learning about the cost of consumption of food, cost of living. And surely rice just has such a great place in the diet in terms of feeding the hungry world. I mean, I think probably half the world's population relies on rice. And is there thinking that, well, you really don't have to be such a premium product. You can actually be a product that actually provides humanity with a great source of food.
Yeah, to answer it quickly, I mean, rice is the most consumed carbohydrate on earth. Over 3 to 4 billion people rely on it as the predominant calorie intake of their diet. I think from a commercial perspective with rice, though, a lot of those industries are protected. So there's a lot of government sort of intervention and protection we see, whether that's from Europe into Asia, and a lot of it's quite locally grown and very low cost. And so as a sort of traditionally an Australian grower, with the input cost increases that water reform has driven into the growing base here in Australia, despite the efficiencies that we have, we're not a cheap crop compared to growing rice in Asia, as an example. So we have to very much focus on those premium products and not just sort of the traditional microwave rice bags or rice in a bag on a supermarket shelf. It needs to be a lot more into those differentiated products that we're doing to drive our earnings. And our global scale, whilst we're one of the largest rice companies, we're a very small percentage of the global rice production. Most of it's locally consumed local.
I mean, stretching out Steve's question a bit into the cost of living, which is going to be banged into us for the election campaign for the next 8 weeks. With that sort of push, is there any sort of effect on your company with that cost of living push coming through, and maybe costs in general for you, Rachel, because of the, I suppose, the seeds business?
Yeah, I guess we're a little bit more, we're a step behind. So I think some of the trade environment at the moment with the tariffs coming out of the US are changing trade flows, which are making us think differently about just how we operate our business. So I think that's a really interesting piece, but the cost of living piece isn't hitting us in our oils business because we're a little bit further removed from that today.
Any cost of living issues with almonds? I mean, people just eat them because they're a pretty cheap form of protein, aren't they?
Yeah, well, we would absolutely argue they're relative to the level of protein, they're a low-cost food. I think one of the things that is interesting, I think, if I take a slightly broader view of your question, is the issue potentially around government policy and water, actually, and the impact of that in terms of the way that flows through, not only in almonds, but across olives and other products, across dairy too, for that matter. And I think there's an interesting interplay between the desire to look after the environment from a government perspective and the impact of cost of water as it flows through across all food products and all food stuffs, and impacts mums and dads and families when people are at the local supermarket doing their weekly shopping. And I think that's a not well explored avenue from a political perspective, at least in terms of the way that agriculture is supported and should grow relative to the needs of Australian families.
Yeah, and that's something I think Gunther's commented about as well on your cost base with energy and people.
Yeah, and I think the cost of living is very interesting. We've seen a few things happen over the last year. One of them is what we call channel shift. So as we look at the different channels where we sell our products, when times are tough, what we call local trade, so cafes, corner stores, bakeries, petrol and convenience, very difficult channels. You know, if you look at petrol and convenience, whether it's been tobacco reduction or it's been the consumer hitting the pocketbook, they're not getting out of the car as much to buy products in the petrol station. Where we've seen that, it's not that consumption's disappearing. Where we're seeing that happen is people are moving into grocery and discounters, and the discounters in particular. So we're seeing that channel shift. Within the stores, the capability of your branded company that we need to build is what I call revenue management excellence. So we're now investing a lot more energy and some money in the toolkits to do promotional optimization. So if I look at Farmers Union pouches, if you go into a store and you're looking for yogurt for your kid's lunchbox or snacking, how do you best promote that yogurt? So we were doing 50% off on a single yogurt. And then we realized that a lot of parents are going there to buy the yogurts for the kids' lunchboxes. So we had 5 pouches for $7.50. Raised the price a little bit. That was a terrific success. But we're sort of going, geez, actually the consumer loved it so much, should be 5 pouches for $8. So we'll go there in a couple of months. So the science of exactly how the consumer responds to price points, to different offers, to execution in the store, to end aisles, to on shelf, it is a science. You get market share data, you interface it with margin data, and you try and optimize your outcome. And for a big company at 3 billion, we need to do that really well. So how we build that capability is one of our biggest priorities over the next couple of years. For cost of living, we also offer formats that are great for value. So Farmers Union 1 kilo yogurt's going crazy right now. Like literally the production line is almost full. So you're seeing consumers move into those value formats, and to the extent that we can offer those along with great promotions, that's sort of the key to success.
You have a few brands that you can sort of.
Yeah, we do. I mean, it's interesting. I think in a softer environment, we typically do better, and we probably put it down to, we don't play in the food service area at all. And we put it down to households eat out less if they're eating at home, and they typically, our consumer will buy a better product. But we also equally, we invest a lot of money and time on educating consumers, educating healthcare professionals on the health benefits of olive oil, and we tend to find that the consumers generally won't compromise when it comes to health. So we work that angle very hard. Olive oil's a heavily promoted category as a rule, so we participate in that. So I think our consumers that can't afford the oil, we have promotional programs as well. But as you said, we play in different spaces within the category, in the good, better, best, being Cobram, Cobram being the best, and then Red Island, and we're also helping our retail partners out with our private label offering.
I think if I can, there's 2 key shifts that we're seeing. If I look at it from a retail and consumption trend in Australia and outside of Australia, in addition to the channel shift, which is absolutely occurring, less eating out, more eating at home. They're in the grocery space, the shift to private label in times of when consumers are seeking value is a threat to branded businesses. And so I think it's really important in those environments you focus on your points of differentiation, on innovation, and on bringing something to consumer that they're willing to pay value for, solving making cooking easier at home in our case, unlocking different flavour meals, giving protein fortified, which seems to be in everything at the moment, particularly in the US even more than here. But it's also important to be differentiated. For us, our Toscano brand's flying. So #1 pizza base in the country. Cooking a pizza at home is still much cheaper than buying a Domino's pizza. It tastes a hell of a lot better if you use our pizza base.
With a bit of olive oil.
With a bit of olive oil. And some nice Bega cheese on them.
There's some questions at the back there. Maybe Paul first, then come back to Steve.
I think he's still got.
Oh, he's still got.
No, he's still going. I'm still going. Just back to Sam. I mean, the move from Cobram to the US was always an interesting move relative to exchange, relative to what we perceive the cost of land to be in the US. versus producing more olive oil here and exporting it to the US. Can you just help us understand the rationalisation of actually going into California, buying land, and what you saw relative to Australia in terms of costs and also the risks around, you know, whether frost was a bigger sort of issue there or not, or just, you know, a bit of that thinking behind that move?
Yeah, I think probably a competitive advantage when we initially went over was that on the processing side, that we were getting 10% more oil out of the fruit than the next best processor. So attracting growers we felt was going to be relatively straightforward, and building a plant. Why we didn't export and develop a market over there is, I mean, it's as simple as there's a clear trend, and there's a group over there called California Olive Ranch who are doing a great job. There's a clear trend towards consumers buying local, because they understood that with olive oil, fresh is better. The fresher it is, the better it is, the more healthy it is. It deteriorates over time. And the consumption, the supply-demand dynamics was less than 3% or less than 2% at the time of what was consumed was locally produced. So we felt that there was a huge opportunity there. I think, you know, what we found, the processing, the growing, the building the plant side was pretty easy. Developing and building the brand was really tough, and developing a good management team. I think any business that goes overseas would do the same thing. And it probably took us 5 or 6 years to get that right. Once we got that right, and once we started to get momentum with the brand, it actually becomes easier and easier, because you're talking to the Walmarts instead of being brand number 300, the guys from Australia who tell you they know what they're doing. You're top 10 and they want you in there because you're performing, you're the second fastest growing brand. So it becomes easier and easier to get bigger. But there's probably time 5 or 6 years ago and we said, what the hell are we doing this for? But it's in a great spot now.
But the relative cost of land?
Yeah, relative cost of land. So it's actually slightly cheaper, and even converted to Australian dollars in the US. And predominantly around the land we're buying, you get access to water. So you're effectively buying the water rights and the underground water. The big difference with the land we're buying there, it's in the Central Valley of California, terrific spot, half an hour from the capital of California, international airports, multiple crops, you know, whether it's almonds, walnuts, olives. So it's terrific land. So we think, you know, we think they're great assets to buy, let alone why we're doing it, which is to produce oil and continue to build the brand.
G'day guys, thanks for today. Look, you guys would have no shortage of data in your businesses. There's a thing called AI. How's AI being used in your businesses now, and how do you see it being used in the future?
Yeah, it's a great question. And you know, I saw in this last earnings release cycle, we're getting that question more and more. And there's really two or three areas that have a more immediate impact for us. One is the pricing area I just talked about, promotional excellence, because when you think about it, it's massive data sets. Now that's more of a predictive AI than it is a generative AI. And so that tool set's really important. The second place we're using it is we have that huge cold chain network. So when you think about the exact routes and which customers are on which route, what drops are you doing, when do you schedule the route, it's an enormously complex data set there again. So distribution networks, revenue management. On a smaller example where we use generative AI, we probably have fewer use cases, but if you've seen the new dairy farmers ad, starts with oomph, that's come out. That was actually sort of initially brought together by a scraping of generative AI to come up with concepts. And it was among the concepts that the generative AI sort of brought forward as a first step. And we filtered those to try and arrive at a campaign for dairy farmers. And it was a tricky one because we're doing everything from milk to yogurt to all sorts of other dairy products. It's a very broad brand, but generative AI played a role in that. So right now, I'd say more predictive AI. Generative AI is just kind of starting, but we're excited to sort of think about the use cases. I won't say we've nailed that yet.
I agree, it's a good question. I think we've got AI really happening in two places. One's very much a starting place, which is looking at a number of our back office systems and processes, seeing the opportunities for AI in that space. And that's an early part of our journey. But the most significant thing that we've been doing in that space actually is about using AI for crop forecasting. And so we've been running that for a couple of years now. We're building the sophistication of the model as we go forward each year. We think that we've got it. So horticultural team think that we've got it to the point that it's in the realm of useful at a macro level in terms of what our overall crop forecast will be. But at a sort of individual farm level, we've still got a lot of variability in terms of what actually spits out of the model versus what we see in terms of any given year. But we think there's a real opportunity in crop forecasting. And the other thing we think is really fascinating about it, if you let your mind wander forward, is our ability to then take that into thinking about potential for crop insurance. Because one of the issues around insuring crops is when there is a lot of uncertainty around what the outcome is, the premium gets really substantive very quickly. And so the insurability is quite low. So we're starting to, in the conversation at the moment, to see whether or not we've got enough and an insurance organisation can have enough confidence in our AI crop forecasting to allow us to get to a space where that would be a reasonable way to think about how we run the business.
Yeah, I'll take that from a different angle. And if you think about plant breeding or plant science, we do thousands of trials all over the world every year, and we cross thousands of different plants to produce hybrids that we test. So we've got a lot of data points that we have. So we're investing in that data science capability from an R&D perspective, because if you can shave off time through that plant development cycle, typically takes us 8 years from concept to delivery in terms of a new hybrid. So if we can just shave days off that at every point, it makes a significant difference to our business. So we're really looking at it about how does it inform the product development decisions we're making in R&D.
Some similar things. So, I mean, it's underrated how much AI could be used internally to remove manual roadblocks, and kind of as you get more scaled and you have more people doing different tasks, just the amount of time it can free up is amazing. So we have some great examples where we're using it there. But externally, probably two key areas. So the first is in helping growers make better decisions through the crop growing cycles of when to do certain things to their crop. And that's more predictive AI using past knowledge coupled with real-time satellite data to help growers make decisions on when to drain crops, when to do certain things to it. And then the second one is we buy a lot of rice from a lot of different countries at a a lot of different price points throughout the year. So sort of optimizing your buying models to what your consumer needs are. So you think about SNAP cycles coming through from, scan data and retails through to what you're buying, from Cambodia for rice, and how do you kind of link those together? It's an insanely complex set of data that no human does well. So we're sort of looking at models in that space as well.
All right. That's the final one. I just might ask a sort of a 12-month question down the line. So what should we be, what's the surprising thing perhaps that we should be focusing on that come next year when we have this discussion? What would surprise you most? Because we've got a lot of things going on. We've got a federal election happening. We've got Trump doing his spinning things. We've got AI. We've got productivity challenges, cash challenges, energy challenges. Is there something that we haven't discussed today or hasn't been discussed in the broader market that we should be looking at to ensure that we make good investment decisions for 12 months down the track?
I'd be very surprised if the world's less volatile.
Going in early gets an easy one.
Yeah, but I think that's really important when you think about, particularly for us with global supply chains, when you think about what markets you're looking to expand in, where you're looking to deploy capital, and how you're going to service those markets. The world's been rewritten at a faster rate now than it ever has been post World War II, and so really carefully considering the geopolitical aspects and how they link to what you're planning to do commercially is, I think, going to be the single most important thing to focus on globally in the next 12 months.
Anyone else?
Yeah, I would build on that. I feel the same. I think as we're making decisions in our business, it's much more with a global lens and a regional lens than ever before, because the impacts cross-border in terms of particularly in the trade changes at the moment are really changing things in real time. So we're having to get better about how we think about the implications globally and not just regionally in our business.
Well, I think I'd ostensibly give the same answer. I think we're seeing a sort of some quite fundamental change in terms of global political position at the moment. You can be for or against what's happening out of the US. So let me not try and dive into which side of it is the right side or the wrong side. One of the better way to describe it. But I think we're seeing a lot of change happening at a really substantive pace. For example, I referenced tariffs in my piece, and I can certainly paint a story, and I did, that's clearly good for the armament position. But the question is, how's it all going to unfold and what's it going to mean for global economies, and then where will the world shift to? So I think there's a lot of uncertainty around the sort of rebalancing of the world order that's occurring. Even what happens in Ukraine affects things like urea prices, can affect global shipping routes, the ability to get product around the globe. So I think there's a lot to unfold and unplay. You'd be braver than me to try and predict exactly how that's going to unfold. So I suspect the solution from a management perspective to that is quite similar to the solution, at least in my experience of when COVID was underway, when you suddenly found your ability to sell into one market opened and closed as the pandemic moved around the world. The thing that made the difference was having an organisation that was agile and capable of being flexible and realigning its supply chains in that case, or realigning the way it ran its processing plants, or so on and so forth. So I think agility is going to be the thing that's required to manage through a really uncertain next sort of 12 to 18 months.
I think the exciting opportunity for Australia there is, I think about my last 3 roles, whether it's been Penfolds wine or it's been Blackmore's vitamins or now it's sort of cheese and yogurt. Australia has a terrific sort of perception across huge regions like Asia. And the perception is really about, regulations and laws that sort of keep our foods safe and of high quality. And I think consumers around the world really believe in Australian food. And so even though it's only a single-digit part of Bega right now, I probably get questions and input from our investors and thoughts on how that can grow well beyond the current size of the business. And for us, that's encouraged us to say, listen, if we can grow a business of that size with limited resources, as we begin right now to accelerate the resources that we're placing against our international business, how do we sort of take advantage of this opportunity to sell great Australian food to the world? And I think if we can take advantage of that opportunity in this room, that will unlock some of the best investment decisions that you're going to see over the next 10 years.
Yeah, well said. I think, I think regulation and taxes and compliance, particularly this state, hopefully that burden gets lessened, in the coming years. It's to make particularly Victoria a better place to invest and a better place to expand. I think with the difficulty of the more difficulty with cross-border transactions, we're seeing, particularly our company being a domestic producer selling into a domestic market, we see that as a big advantage, and we hope that Australian consumers get behind that, and for our US business, US consumers really get behind Californian olive oil. So we're starting to see that trend emerge, particularly for our company.
Sorry, quick question.
No, can I just build on that? Talk about Gunther about opportunities in Asia. What about Europe? If Europe becomes anti-American, and as it seems to be where it's going, do you see more opportunities up into Europe? And sorry, that's for everyone. That's not just for you, Gunther.
Quick answer.
Yeah, we probably won't focus as much on Europe, mostly given the distance that we'd have to travel. And I would say in dairy, they've already got some great niche cheeses and this and that. Beyond Asia, I do see the Middle East is exciting for us. And there's a lot of money over there. So a lot of people call out Asia. Don't forget what's happening in the Middle East and the scale of the funds that are there. So as you think about an investment thesis, that's another region to watch. And we're certainly making some investments there as well.
Any quick answers across the
Europe for us is not a market either for a number of different reasons. Primarily, we don't have an established footprint there, and to Gunther's point, the Middle East, we're the number one position across a lot of that market. And you look at what's happening in Saudi Arabia, the demographic shifts and the wealth, not just the wealth, but the consumption shifts that are happening with female participation in the workforce and time for people looking to cook more. That it opens up a whole raft of opportunities for us, and we have a great footprint there. So Asia, Middle East, the US for us is where it's really important.
No, certainly not for us. We say there's enough opportunity in Australia, and obviously the US is a huge market. There's actually a tariff on sending olive oil over to Europe, so that's always been a little bit tricky. So that's predominantly why we started to focus on a domestic market, and now we don't have enough supply, so we've got our hands full with those two markets.
So I think from a select harvest perspective, we do put some product into Europe. It's not a large and significant part of our portfolio. I think the impact is more likely to be this. I don't think we'll end up putting more product into Europe particularly. But I do think there's a possibility as the EU retaliates in terms of tariffs, and I did mention this earlier, that what you will see is a rising tide floats all boats. So I think it is possible that you'll see, in fact, a fundamental lift in all global prices as the supply dynamic shifts around.
Europe for us, as I mentioned, is predominantly the opportunity around biofuels. So if you think about carinata as a product and an oil, we're currently exporting that from South America and into Europe to help decarbonise Europe's roads. So that's the most significant opportunity for us, and also for our omega-3 oils as well. In terms of where we're focusing from a production and a seeds perspective, hence the focus of my presentation today, South America is our greatest opportunity for growth.
All right, well, that's right bang on time, which is always fantastic in these results. And we do have some drinks out looking over the beautiful view. So we do want to thank KPMG for allowing us to use this facility. And thank you very much to panel 3, David, Rachel, Gunther, Stan and Paul. I think it's been a great way to bring it home. And thanks again to CBA for sponsoring and the team here. Thanks to Brooke, Craig, James, Paul, Joe, and Hayden and Co. They've done a fantastic job, and look forward to continuing this, because this is all about bringing the risk profile down to a reasonable level. And we do think that sort of growing through the cycles is what we need to prove to that wider community. So when we do run these results and presentations in the next couple of years, we do break through that barrier and get the institutions off the online side and in the room. Talk soon. Bye.
That's interesting.
I mean, that's what you